we'll just discuss each of your organizations, a bit about your mandates. Perhaps starting with you, James, just discussing Big Society Capital's mandate, specifically focused on crowding in more impact capital, how that happens, why catalytic capital is important, and providing some illustrations of how you do that too.
Sure, of course. And I think, first, thanks for having us here. We've been around for about 10 years with a specific mandate to bring more of this capital in the UK. So we have the tool of investment, and part of that is around always bringing other parties alongside us. So it's inherent with our mission, whether we're doing blended finance or any of the strategies that we use, always there are co-investors alongside us. So that's one part of it. So everything that we do is around finding those solutions, moving first often, so being catalytic in that sense, but then making sure that there is a sustainable solution that when we want to go and do the next thing, or when we see the next thing that's there, there's part of some of that stuff. So we've been around 10 years. In that time, we've done about 890 million pounds of commitments, and that the organizations alongside us have then put an additional 2 billion in that. So we're getting to a place where we can see some of the impact. And I think that's the really important thing, that when we talk about a session and a panel on blended finance, the elephant in the room is what's it for? Because you can't miss the point. And if we might think it's really cool to talk about structures, because it is, and we might think it's really fun to talk about leverage ratios and that sort of thing, because it is. But it's about that deep transformational change. And so when we are putting our capital to work, we're acknowledging the everybody has a role to play with the resources that they have in this solution. And for us, that's what's at the heart of blended. So we look at the solutions, whether it's around targeting homelessness, or whether it's around finding solutions to support a just transition into the net zero future around some of those things. Actually, those are deep entrenched issues that a very linear approach to financing isn't going to be the answer. And therefore, everybody needs to take a look, go, what resources have I got to bring to the table if I want to achieve that impact in a sustainable way? And that's really at the heart of when we look at blended finance structures or blended finance products. It's about allowing more parties to play more of a role to create some of that impact, which is all of our job as we look at the society that we need to create in the future.
That's right, James. Thanks. Thank you also for starting and placing us in that problem area, right? This is why we're here. We're not here to create financial structures for the fun of it. We're here to solve problems. So with that being said, we'd love to discuss, Cilia, sort of where your problem-solving journey starts and what's the mandate of your particular organization with respect to using blended finance and catalytic capital.
Yeah, I wanted to say, I was 2, I was in the garage with my dad. That was where my problem-solving career started. But I think this time around, I think one of my key lessons coming from impact investing, where you're there to prove the point that impact can be a driver of profits, a driver of financial performance. You have a lot of the VC impact funds saying high impact, superior returns. You end up looking at 1,000 companies, and you get down the funnel, and the one that you're favoring is still the software companies. And I think the thing that was really important to me when we put up the foundation is that when you get down that funnel and you choose a software companies building a marketplace on top of a dysfunctional carbon market, you're not getting to the deep impact unless we're also investing behind the technologies that allows us to move the capital for it. And when we talk about deep impact, that is about changing the physical world. And I think all startups in this arena can have a familiar sense of I'm doing something that's really hard, or I'm putting a software shell on top of it to help the others. I'm enabling environments. And both are important players. But I think the piece here is that you called it linear, but I think the venture model that was built for software is not fit for purpose when it comes to these a little bit harder ventures and companies to build. They need more grant funding. They need more research and R&D funding. It takes longer time. So when we built EQT Foundation, we looked at it a little bit different. We said, we still believe that impact drives value for society and therefore also profits long term, but it's going to take a little longer. So we're going to use our network to help them accelerate to market. So we support entrepreneurs and researchers taking their breakthrough impact ideas from lab to market. But we're also doing it in a new way of thinking concessionary. So back to James' point of like blended, yes, it can be inside a structure and a fund vehicle where people and investors take different types of roles and risk profiles. I'm okay with taking out less profit. I'm okay with being the first loss if this defaults. But you can also think about it as an ecosystem of players. And then it's about how can I offer up more than I take? Because if there's something here of value to somebody else, it will de-risk more players coming into the game. And if everybody starts thinking about what can I offer up, you create an ecosystem. And then you can create an ecosystem around what you want to invest in.
That's right.
So the underlying asset for us is still companies that will show profits when they've gone through the initial hurdles. So we're here to de-risk it as one of those players for more conventional capital coming in.
Excellent. I'd love to dig into that even more so with some examples, because I know your model is somewhat unique in terms of the patient route that you take. So fabulous. James, you talked a little bit about partners a bit early on, and I know that for big society capital, partnerships are important in addition to the right structures. Could you just describe what makes a successful partnership work, especially when you're implementing at the local level, community-driven problem solving using finance?
Yeah, great question, great framing. Almost anything that we do, if it doesn't involve partners, is almost not the point, because there is a sense in which to create the market around some of that stuff, there needs to be broader engagement around that. Now, in the context you talked about in terms of on the ground, in the communities around some of that stuff, there's a, part of the impact that's being created has to be involving and designed with and by and with the individuals in that community. And so we did, for about 3 or 4 years, we were looking at a sort of a place-based approach to certain work that we do. This is, there's a buzzword about place-based at different points in time, in and out, whether we talk about community investing in different ways. But actually, if that's just plonking money into a community and then walking away and expecting it to do the job, actually that's not going to create the long-term systemic impact, transformational impact. Not least because it's not brought the people for whom or with whom it needs to be done along with you. So you need to have those deep relationships in place, the people who understand the local needs within the context of the partnership. They need to be involved in the decision-making process along the journey around some of that stuff. And they need to be connected into the outcomes and the outputs of that so that as a community, they can learn. So we've got an example in Bristol at the moment where we put £5 million, so small fund, pilot fund, alongside the local authority there to make a £10 million pot. And it is blended because it has other providers of different types of capital alongside to do some of that earlier field building work or earlier ecosystem development work. Now that could look like feasibility studies for a model. It could look like operating costs to get somebody, for working capital, to get somebody to a point in time. But that combination of local partners that are there, who understand the system and understand the issues that are there and are plugged into the wider piece to then bring others in. The different types of capital or resources, some pro bono resources, I know that's part of your model as well, Cilia, around how some of that stuff comes together. And then the capital as well starts to provide that base for shifting the dial slowly but surely along the edge of some of that stuff. It's not sufficient, but it's the necessary conditions for some of that stuff to happen.
It's a critical feature. Exactly. Thank you so much. Cilia, with respect to your work, especially building individual companies and making them more investor ready, can you describe some specific examples of how you look at technical assistance and grant making a bit different through perhaps a different prism and applying your finance skills and business skills to build teams that are truly investable?
So I think one of the ways that we are concessionary is that we take a very strategic ticket on the cap table in the companies, and then we try to deliver an outsized support. So as if we had an equity stake that was much higher. So they get the same for us independently of the percentage we're in, really so that that kind of amount of effort is de-risking it for others to come into it. And I think what we do for every entrepreneur or startup we invest in, we match them with 3 employees across EQT. So if there's a company in tech, we have somebody on our legal team that helps with IP. You have investment. We had carbon negative, durable bioplastic companies that we invested in. So every ton of CO2 was captured with every ton of material. And then we had somebody in our private markets or private equity business line that had spent 6 months researching bioplastics to look at investment opportunities in the area. So being able to both match that experience, but also match the experience of our portfolio companies. So EQT owns 300 companies. They can be potential first customers. And they have been through the same regulatory process that some of these young companies need to go through. So that's also a way where we help to shorten the time it takes for them to come, i.e. making them more as a classical venture investment where they see, oh, they're actually going to get to market, and we see the proof points, and we're able to prove the link between impact and financial performance longer term.
Excellent, excellent. Well, perhaps we spend a little time just on that notion of exits. That's always a pressing thought of what happens after you make these investments, whether in the form of grant or catalytic capital or patient capital. So perhaps, James, talk about Big Society Capital's journey with respect to taking an enterprise all the way to exit, to really truly being market ready, and then subsequently perhaps raising rounds of capital.
So first thing to say is we are investors in funds. We're a fund of funds organization. So our investment horizon in some of those sorts of things looks slightly different from how you might typically exit an enterprise in that sense. Now, there are principles around some of that stuff that absolutely apply, and there's a couple of examples of that. So one is around ensuring that there is alignment up front when you go into a deal, that what you are trying to achieve is going to be there and is going to be baked in the long term. So again, this is around that framing of what do I want to achieve? What resources do I have to bring that's at the heart of this blended model? People bring different things. But unless you have that alignment from the outset, then the exit route or the exit path or decisions you might make when things get tricky or difficult or might need to pivot, actually, without that, you sort of lose your compass. So that's a really important point that we make sure that's there. I think then as you go through that journey, it's about communication and it's about understanding, is this a change or a pivot to exit that's needed for what reason? And again, that comes back to the value that you're trying to solve for in various pieces around some of that stuff. But I'll defer to you in terms of the ventures or the enterprises themselves and how you might transition some of that journey.
Yeah, and I think as a impact investor or as an actor in a blended finance, it's about the stability of the change that you wanted to be part of making, and that your role of capital has played the part it was meant to play. So for us, if we are in there in the very beginnings to de-risk it, and then we suddenly see, okay, they're past this point, a lot of people are coming in, they don't need our capital anymore, then we might pull up, not follow on, but still sit in as long as our support might be able to help the startup. And I think it will always be an opportunity cost, because you're looking at blended finance. That's people who are coming in with a portion of capital that can take more risk, can be patient, can also accept lower returns, can be first loss. So you're going in with an offering to the market, and that offer can be made somewhere else. So you have to make sure that this is the right place for my capital to play, and that I'm not sitting in if it could have made more impact another place.
Yeah, and I think that's both of you are making incredibly important points, and that in particular is a really good takeaway for the audience, to understand where you sit in that, what we would describe as the blended finance value chain, is to not sort of walk away and think, God, this is very complicated to structure these blended finance solutions. It's not something that we should pursue XYZ, but instead ask yourself, what part do you or could you play? And we can dig in. Cilia might have a
No, I just want to say to the audience, blended finance, yes, it's a definition of different pools of capital inside a structure not acting together to drive impact. Think about if you are an investor in this audience, be part of the informal blended finance and say, I'm going to offer up more than I take. I'm going to do something that's easy for me to give, EQT has 1,800 employees across the world that are investment professionals. So when we started a foundation, we were like, this is easy for us to give back into society, giving our employees the opportunity to use their skill sets to give back. Everyone as an investor has that resource that allows them to be a profit to others. Because that is what's going to drive a strong ecosystem for driving impact through the financial markets. If everybody dares to be a profit, there's also going to get that back, and these ventures are going to finally succeed. And I'm also hoping that we will see, as we've seen for climate tech, a development in paying the investors back for driving the impact. So a climate tech startup are getting paid for carbon offsets to the market. So they're getting paid for their impact outcome. You don't see the same, for example, in healthcare. There's nobody who's paying you the extra cost that it takes to go into a rural area with healthcare services. So it's really about...
The premium. What's
yes.
the premium? Yeah.
Yes.
And I think that, for me, that's the heart of the role of blended finance. It's effectively a bridge. And that can be a bridge from capital into the structure. So what does that structure need to look like or have as its components in order for an investor or the role you want to play in order for you to be able, it could be size, it could be credit enhancement or risk profile around some of that stuff, or it could be simply around education and understanding what that is and taking some of that role. Or it could be a bridge from the investment vehicle into the communities. And we've got a few different examples of where that has been really valuable, so there's an organization called Social Investment Business, and they have a fund that is a blended finance fund, and that's blended because it's got a guarantee as part of that, as part of the structure, but it also has an element of grant for first loss and for changing the dynamics and some of the terms to reach and bridge into specific underserved groups. So they did a fund during the COVID pandemic crisis, making the use of some of those guarantees that effectively allowed them to develop the architecture. Having learned from that effectively one-year crash course in keeping the lights on for some of these organizations, they've then adapted that in the follow-on fund to go, what we noticed was we only had 4% of black and marginalized groups who were leading the organizations we were. Why is that? So they spent a period of time learning, understanding some of that stuff, and then building a structure and a product that would allow them to address some of those issues that they heard in partnership with others. And where they're now up to is 4 or 5 times that amount in terms of the black and marginalized groups. So 20-odd% of those are black and marginalized group founders. But they've also then got a broader diverse-led group of 75%. So it's, again, changing that dynamic, playing that bridging role into where finance couldn't previously walk across.
That's right. And again, 2 things. One is solving a problem. You know, the undercapitalization of founders and of enterprises, perhaps, that weren't receiving capital in the markets without a blended structure. But then second, using things like guarantees. Guarantees have been available for a long time. So not forgetting that these tools are available to funds and enterprises to really capitalize or mobilize more capital. So with that, James, we talked a bit about the community development funds.
Right.
I mean, this has been in existence for decades. And
Yeah.
so tell us a bit about how Big Society Capital is really drilling into that particular sector.
Sure, and this is one of the things where nothing's new under the sun, a bit like you talk about with guarantees, and yet it gets a new fancy term, a bit like impact investing at a point in time. And people were doing some of these things, and so we shouldn't forget the examples and lessons that we can learn from some of those points in time. The CDFI, or Community Development Finance Institutions, is one sector around some of that stuff. They've just published a report in the UK where they talk about, where the strapline was so great, it was, you gave me a chance. Something like that. It was around that idea of you looked at what we were doing and you didn't overlook us because we didn't look like and fit into your neat, tidy box. They are locally based lending institutions who are disproportionately based in the more deprived communities. There's a big sector in the US, but there's also a growing sector in the UK and has been there for the last number of decades. And what we're trying to do is grow that sector because we think it's a sector that has we talked about, Sophie earlier talked about gaps or amounts that are still needed for capital to have the impact potential in there. We think this is one of those where they are providing vital, very small amounts of finance for businesses who are based in those marginalized areas and more deprived areas, specifically in the UK, that haven't been able to get that finance through the traditional finance industry. And yet, because of the model that they have, they understand those businesses, their needs, and the criteria. And so there is an element of which that is a different risk profile than it would otherwise be if you were just sat in a glass tower in the center of London making those same investments.
Yeah.
But the gap is, how do you get people to see that? How do you get the extra capital to flow into some of that stuff at the right terms? And that's where the guarantee plays a really important role around changing the mix and the profile of what that looks like. So we put together a facility a few years ago where we put £30 million in. There's also then a senior lender that's come alongside for each of these different 4 institutions. But we're doing that to prove a model and to prove a point, as well as develop the track record and develop the infrastructure and the elements that over time, hopefully our role, to your point, at the exit, can be diminished. So that traditional investors might look at this and go, let's follow on and follow on and follow on. And that's great if that's where you want to play. But for us, our mandate specifically is to close those gaps, find those gaps, build a case around the bridge. Now, that could be a permanent bridge or a temporary bridge, depending on the type of gap that we're trying to close, whether it's real or perceived risk.
That's right.
But it's creating that sense of, there is something we can do here, and there's a role for other people to play around some of that stuff.
Yeah, that's
So,
so spot on. And a big takeaway for all of us is, yes, we're doing this new financing approach for good, and it's making impact. But the reality is that these sectors and these communities need access to the private capital markets. It creates economic development, which creates jobs, which is frankly really great for commercial investors who might be sitting at the top, even though we're just having this discussion bottom up. So, Cilia, with that, I think you provided some really fantastic examples early on about how EQT takes a hands-on approach. And it's worth the audience hearing a bit more about the time that you invest. You mentioned certainly that EQT offers up its own staff and personnel. How do you spot the pain points that an enterprise might be going through as it is using catalytic capital in a unique way? But then how do you also make sure that that management team is positioned to speak to investors and be catalytic as a management team when it goes out to shop its own deal?
I think on our end, what we really see, and I think can be a key takeaway for any founder sending investor updates, is that what we're seeing, especially in the US market, is that they're really hands-on. I need this. They are very upfront with their asks so that we as a network can give as much as possible. So that's kind of just a big, say what you need. I think we invested in a company that's working to bioengineer trees to grow faster and capture more carbon, deliver better quality timber. 3 months after we invested, they were able to prove that they can grow trees 40% faster. We connected them through our infrastructure investment professionals with landowners, securing them a big contract to plant millions of trees to kind of get to that commercial stage. So I think as long as the startup and the founder, I think that is point, understand that what you're doing is hard to do. Be very specific about what you need from people around you and pull in the network. That's one key learning. I think on the healthcare side, what we see is that solutions and breakthrough ideas that can work in both developed and developing countries, because they might have to go through EU regulatory process to get it approved for markets, and having a volume in a developed world will actually bring down the cost of production so that you can serve an underserved market or population in Africa, for example. We have a company they've developed a chemical blend that mosquitoes prefer more than human blood, so they're mimicking the malaria virus, distracting the mosquito to go somewhere else. But of course, this formula can also be used as a golf court in Miami. I think the interesting point here is to look at some of these startups that has breakthrough ideas. They need somebody to bet on them, because normal investor will look at where's the equity narrative. You can replace an actor in a market and say they're going to disrupt this and that, and the price point and unit economics need to be this to compete. But when they're building a new market, it's so much harder to build that equity narrative. And I think capital that are able to take more risk or to lean in those cases are part of de-risking it. And seeing, I think, also on the trends in the underlying portfolio, what works and what not, so that we're able to move more capital in even before we've seen the realized returns. I think we're at this moment in time where it's like, how can we mobilize capital, and how can everybody like step up, take their role, and like build those ecosystem where we're de-risking each other of going in. I think the circular economy is such a good, important kind of piece where, you know, if I'm going into this company, the entire industry has to change, but the industry fails to change, my company becomes really risky. Right? So more of the systemic investment lens, going in from different investment buckets, place-based, to say we want this transition to happen, actually de-risks everybody being able to go in. And I think the more we get on top of like blended finance and talk about it as finding our roles and de-risking systems change on the ground, we will be able to de-risk each other more effectively.
Oh, that's so great. Wonderful examples. We're winding down a bit, so let's end on this notion of disruptive innovation and transformational innovation even. So what are a couple takeaways for this audience? Making change in the financial sector is not easy, especially systemic change. So what is one of your key takeaways, James, for this ChangeNOW audience?
I've got a takeaway and a call to action. One is that you'll hear a great conversation, and it's fantastic with colleagues around developing markets, that this can happen closer to home in developed markets, and that's some of the things we were talking about today. So think about those opportunities to create impact in and around you. And the second piece here is, you might be there going, who else is doing any of this stuff? I'm alone. Well, firstly, you're in a room, or not a room, but a sort of circus theater stage with other people. We're just starting a community of practice around this, particularly for blended finance, people who want to do more of this stuff and don't quite know how to get into it. So we had a great session with the EBRD, with a partner organization of ours called the Access Foundation, on ourselves. We had over 60 organizations come to a launch event to just find out more. It's around education and learning. It's about sharing and developing best practice, and then hopefully as a community of practice, there'll be opportunities that emerge from some of that stuff. So if you have any desire around that, the call to action, come find me, I'll take your details and we'll put you on a list, and the next time we have one of those sessions, we'll keep you posted.
Okay, Cilia, in the remaining time.
Yes, I'll just follow on, because you were on that end of the scale, and invite any startups that are saying, I need access to this form of capital, to reach out to our website or our LinkedIn page. I think it's really, to your point, this is about finding your place in this. And I think not being overwhelmed by the terminology, just realize I'm here, I want to be part of solving some of the challenges, and I know what I can offer and what I need to be able to move my capital, or if you're on the other side as a company or an institution, of what is my role, because there's also going to be awareness building and community building around getting this to happen.
Okay, thank you for that. Wow, very punctual ending. Right on time. It was a pleasure to be with both of you. Thank you. I also just want to mention that, again, what you're doing is not easy, so thank you for making change now.
I would say it is what it is. Let's not label it difficult or easy.
That's right. It is what it is. And that we're all responsible for being part of that supply chain and supporting institutions like this. So thank you very much.